Welcome back to Investing Talk Podcast.
Today, we're looking at energy fuels.
And we really need to set the stage on the timing here before we jump in. It is Wednesday, February 25th, 2026.
Right, which is pretty much the most critical piece of context for everything we're about to discuss today.
Because they report Q4 earnings tomorrow morning.
Exactly, February 26th. So if you're listening to this right now, you are standing right on the edge of a major binary event.
Yeah.
The volatility we're seeing in the market, it's all positioning for that print tomorrow.
Yeah, it's the calm before the storm, or, maybe the rocket launch, depending on your position. But as usual, before we start, subscribe, like, and comment to this video to support the show.
So energy fuels, this is a name that has been popping up everywhere lately.
Right.
But the narrative has really, it's shifted a lot.
It has.
It used to just be a uranium play, right? But now it's morphing into something much bigger and honestly a lot more expensive.
A lot more expensive is the understatement of the year. I mean, I've been digging through the numbers all morning, and I'm honestly scratching my head a bit.
Why is that?
Because we need to unpack this massive disconnect between the stock price and the actual money coming in the door. The math is just, it's getting fuzzy.
I love a good mystery.
Yeah.
What's the biggest red flag for you on the valuation side?
Okay, so let's just look at the scoreboard first. This stock has been an absolute rocket ship. In 2025, it was up 155.99%.
Huge.
Right. That's a career-making year for portfolio manager. And then just year-to-date in 2026, and we're only in February, it's up another 36.51%.
It's gone completely parabolic.
Exactly. If you only looked at the stock chart, you'd think this company is printing money, like they have a total monopoly and record profits.
Yeah, usually up and to the right means business is absolutely booming.
But then you open up the actual financials, and it's a completely different reality. We're looking at Q4 revenue expectations of just $27 million.
Which, to be fair, is not a very big number for a company trading at this kind of valuation.
It's not just small, it's actually shrinking. That $27 million is a 32.36% decline from the previous year, where they did almost $40 million.
Right.
So walk me through this. You've got a stock that has more than doubled, while its actual sales have dropped by a third. How does a company with shrinking sales create those massive returns? It feels like gravity has to kick in.
It's a fair point.
Yeah.
And if you're looking at it strictly through a rearview mirror, it makes zero sense. I mean, if this was a software company with those numbers, you'd short it.
100%.
But the market is always forward-looking. The story here isn't really about the top-line revenue drop. It's about two specific things: operational leverage and the moat.
Okay, let's start with operational leverage, because that usually just sounds like corporate speak for cutting jobs.
Not always. Here, it's about pure efficiency. Look at the bottom line instead of the top line. Yes, revenue is down, but the losses are narrowing significantly.
How much?
The consensus for Q4 earnings per share is a loss of 7 cents.
So they're still losing money.
They are, but a year ago, that loss was 19 cents per share. So even with revenue falling, they improved their bottom line by 63%.
Wow.
Yeah, it's massive. And over the last 60 days, Wall Street analysts have actually narrowed their estimates from an 8-cent loss to a 7-cent loss. They're getting more optimistic about the company's efficiency.
Okay, so they're stopping the bleeding, but you don't get 155% return just for bleeding a little less.
No, you don't.
Oh.
That brings us to the real driver here, the moat. We have to talk about the White Mesa Mill.
This is their facility out in Utah, right?
Yes, and honestly, you can't overstate how vital this asset is. The White Mesa Mill is the only facility in the United States right now that can process both uranium and rare earth elements.
Wait, the only one in the whole country?
The only one. Think about the current geopolitical climate. Everyone wants supply chain independence. They want to decouple from Chinese processing.
Right.
And Energy Fuels is sitting on literally the only domestic solution that handles both of these critical inputs at the same time.
So if you're a U.S. defense contractor or an EV manufacturer and you need processed rare earths domestically, you essentially have to go through Utah.
You go to White Mesa, it creates these dual revenue streams. If uranium prices cool off, but rare earths are booming because of EV demand, they're hedged.
Scarcity definitely has value. If you own the only gas station in the desert, you set the price. But the price the market is paying for that scarcity right now is incredibly steep.
How steep are the multiples looking today?
Well, the forward price-to-sales ratio is sitting at 45.35.
That is steep.
You're paying over $45 for every single dollar of sales they generate. That's a multiple you usually see in high-flying AI stocks, not mineral processing.
It's definitely a massive premium.
And to give you some context, Cameco, which is the gold standard for uranium, is trading at a price-to-sales of 19.86. Centrus is down at 8.54. So Energy Fuels is more than double the industry leader. It feels very bubbly.
I get that, but I'd argue that premium is basically a national security tax the market is happily paying. Cameco is great for uranium, but they don't have that rare earth angle. Investors aren't paying 45 times sales for what they did last quarter. They're paying for the rare earth ramp-up that's expected by 2030.
But 2030 is 4 years away. That is so much future growth priced in right now.
In the critical minerals space, 4 years is nothing. You can't just spin up a rival to the White Mesa Mill. The environmental permitting for radioactive tailings alone takes a decade, so people are buying their ticket to 2030 today.
All right, so ignore the current sales drop, focus on the narrowing losses, and pay up for the monopoly asset. Let's pivot to the charts and see if the momentum backs that up.
The charts are where this gets really wild. It trades more like a meme stock than a materials company right now.
Exactly. We've seen it trading recently in this $20.29 to $23.33 range, but the relative strength is what jumps out at me. Just in the last month, the stock is up 74.18%.
74% in 30 days. That's a whole year's return crammed into 4 weeks.
And it's completely decoupled from the market. The basic materials sector as a whole is up about 10.45% this month. The S&P 500 is completely flat, up just 0.18%. Energy Fuels is just playing its own game right now.
When a stock ignores a flat S&P and rips 74%, that's institutional accumulation. That's big funds positioning for a structural shift.
It's been a crazy ride, though. The 52-week range is $3.20 on the low end and $27.90 on the high end.
Imagine grabbing shares at $3.
You'd be thrilled. But looking at the moving averages, it's heavily bullish. We're seeing 3 positive signals against just 1 negative.
So the trend is definitely your friend.
It is, but there's a catch in the flow data. We've got about 15 million shares of trading volume, which is solid, but the options volume is unusually high right now.
Getting ready for tomorrow's earnings.
Exactly. People don't pile into options like this unless they expect a violent move. They're either betting on a massive squeeze higher or buying puts because they're terrified of a rug pull. Nothing thinks the stock is staying flat on February 26th.
No, it's roulette at this point. Let's see what the street is thinking, though. How is Wall Street positioning themselves?
Well, usually when a stock runs up 74% in a month, analysts step in and downgrade it to a hold just on valuation alone.
Right, but we actually had a massive catalyst on the sentiment side. Goldman Sachs initiated coverage,
Oh, the Goldman bump.
and they came in hot. They're essentially pounding the table on this stock. But specifically regarding the rare earth story, not just the legacy uranium business.
Which perfectly aligns with your moat thesis.
Exactly. Their note implied a 50% upside potential. When Goldman tells institutional clients there's 50% upside based on a strategic supply chain asset, funds rotate in. It becomes a self-fulfilling prophecy.
That makes sense, but when I run the quantitative sentiment analysis using the top 5 stories metric, it paints a much more conflicted picture.
Really? How so?
It's a tug of war. The bullish stories are all about White Mesa and the Goldman coverage, but the bearish stories are dominating too, asking if they're going to report negative earnings tomorrow and highlighting how the stock sometimes sinks on big green market days.
So the algorithms are confused.
Totally. The overall sentiment score actually nets out to a perfect neutral 0. The humans reading the Goldman note are buying, but the machines reading the negative cash flow headlines are selling.
We did see some positive analyst movement, though, right? Roth Capital upgraded them on January 28th.
Yeah, they move from sell to neutral, which removes a lot of institutional selling pressure.
And the current consensus is a moderate buy, with 2 buys, 1 strong buy, and 1 hold.
That's true. But I have to play the skeptic here. Let's look at the risks, because there's a lot hiding under the surface.
Lay it out. What's the bear case?
I'll start with the scariest number in the data. The consensus price target from those same analysts is $12.06.
Ouch.
Yeah. With the stock trading over $20 right now, that implies a potential downside risk of negative 43.55% if the hype evaporates.
That's the danger of a stock moving way faster than the financial models can update. If the Goldman magic wears off, you're staring down a 43% haircut.
And the financials give gravity a lot of pulling power. Their EBITDA is negative $94.03 million.
That is a hefty burn rate.
Free cash flow is totally negative too. They're in this massive, heavy investment phase, pouring cash into mineral sands and rare earth upgrades.
You have to build a factory before you can sell the product.
Sure, but it creates huge execution risk. Their entire 45x premium valuation hinges on this 2030 demand surge. What if the EV market slows down? Or what if the government changes tariff rulings on Chinese rare earth?
That is the big vulnerability. The thesis assumes trade policy forces buyers to use domestic processing. If geopolitical tensions, cool and cheap foreign materials flood the market, that premium vanishes.
And then there's the immediate risk. Tomorrow, if they report Q4 earnings and miss that $27 million mark, say they hit $23 million.
It could get really ugly really fast. The people buying those short-term options aren't long-term believers. They'll dump it at the first sign of weakness.
It's a high-wire act. So balancing the White Mesa moat against a 45x sales multiple and a $12 price target. It's time to bring it home. What's the final verdict?
I'm giving it a bullish score of 8 out of 10.
An 8. Even with the downside risk.
Even with it. Because my thesis is simple. Energy Fuels is not a trade on tomorrow's Q4 earnings. It's a trade on critical mineral independence.
You're buying the asset.
I am buying the White Mesa Mill. It's a unique strategic asset with a moat that literally no other company in the country has.
Yeah.
The recent 156% gain is just the market finally waking up to the blue sky potential here. It's a multi-year hold into 2030.
I hear you. The long-term vision is compelling, but for anyone listening, I just urge caution regarding the volatility. By tomorrow morning, the data changes. The options market is pricing in chaos, so protect your downside.
Absolutely.
Energy Fuels, it's an incredible story to watch.
It's definitely not boring.
Subscribe, like, and comment to this video to support the show.